I wanted to walk through a short strangle setup, the process of going through finding the trade and going through the option chain, doing some quick analysis, and then actually making the trade. And then talk about what I need to worry about, some of the precautions that I have to take when I make the trade. I was talking to a buddy of mine this morning, and he wanted to know about short strangles, and I was kind of talking to him and explaining to him, and I realized that it would be great to actually make the trade, walk through it, and actually follow it and see how it performs, and follow it through the end, and see how the trade works out, how I might adjust it, if I do need to adjust it, what do I have to do, why, and go through all the possibilities from start to finish. So the trade that we were talking about was BABA. Let's first just look at what's BABA doing. For me, I just kind of see what it's doing during the day. This is an intraday chart. I just quickly take a look at what BABA is doing. It's pretty much doing what the market's been doing. It pretty much tanked in the morning and came back, and now it's settled. So BABA, if I look at the chart here, BABA has, the first thing I like to look at is the implied volatility. This line here, this yellow line here on my chart represents implied volatility. And because of the market turmoil, plus, and I'll talk about this in a moment, plus BABA has earnings around the corner, both of that together is producing very high volatility in BABA, which means the premiums will be higher than usual, which means you can sell pretty juicy, expensive calls and puts and get a lot of, and taking a lot of premium, which then gives you a better chance to profit on the trade. It gives you more probability, put the probabilities on your side, because you're getting much more bang for your buck. So we know now the first thing's the most important. First and foremost, implied volatility is decent in a short strangle candidate, and in this case, it's not only decent, it's good. It's really high. Second thing is, what's BABA trading like? In this case, BABA made a high at 105 back in Feb of 11. This is February, and since then it's kind of gone down, bottomed at 57, hit a ceiling around 85. So I'm looking at back from since July, it's kind of been, it's hit a ceiling here at 85. 1, 2, 3, 4, call it 4 or 5 times, and it bottomed at 57. So from basic, simple kind of support resistance kind of analysis, I would say, and look right here, so BABA's right in the middle of it. So I would say, if I were to sell a short strangle, I would ideally want to be somewhere around the resistance and the support. So let's look at options at the 85.60 level. Let's see what we can get from there. So I probably, in this case, will pick either 36 days out or 64. Probably 36 in this case. I don't really want to go more than 45 days. 45 days is like the sweet spot. That's where after 45 days the theta kicks in. If you go past 45 days, the longer you go, the more premium you get, but then the more opportunity for the stock to move around. So you're not getting your best bang for your buck like after 45 days. But in here, if I go to Feb, if I look at, what did I say? I said 85.55, 85.60, around there. So okay, cool. So 60 is selling at $1. That's awesome. And 85 is selling at 42.44. That's good too. So it looks like the premiums are really good here. So I'm going to go, if I want to go 85 and 65, 85. I wonder if I can do, the 82s look decent too. So 82 I can sell for 72 cents. That's pretty good, 82. So 82 is about, and if I look at the risk graph, I just look at this risk graph and I look at the 10% marks. That's kind of my baseline. So 82 is somewhere around here, and that's going to put me at 15% on the money, and 65 will put me at 69% of the money. So I like that. I actually like that. So I'm going to be a little more aggressive. Okay, so this is my reasoning behind choosing 82 versus 85. I like the 82s because I want actually more hedge with the environment this shaky with the whole China mess. I think there's a chance that BABA could go down again with the markets. So I'm afraid that the markets might tank again, right? So I don't want to be too bullish on this trade. I want to be as neutral or slightly biased to the downside as possible. The best case scenario is slightly biased to the downside, and making sure that your implied volatility is high. So let's go ahead and sell the 82.5 and I could even be more safer and go 57.5. But I'm going to go with the 60. See, even the 57.5s are decent. You know, there's premium in these options all the way down to 55. So if I wanted to be even more safe and give myself more probability of success, the further I go, the more chance I have of making money and the less risk I'm taking. But then the further you go, the less credit you get in. So you can always see that there's going to be a risk reward, a give and take kind of process you have to go through. So the further you go out, the less chance you have of getting, hitting your strike, but the less credit you'll take. So in this case, I think 60 is pretty good, and I'm going to go with the 60 and the 82.5. So I have plenty of wiggle room right now for BABA to move around. And I want to make sure BABA is still, behaving normally. I just like to check and see what it's doing in the intraday, so I don't catch it in some kind of all of a sudden. The markets move so fast these days. If you don't pay attention, something could move and tank in a couple minutes, and you're not paying attention. So right now the market's kind of calm, and BABA's kind of calm, so I'm not too worried about getting bad fills or anything. Yeah, the market's moving fast, and you tend to get bad fills, and it's kind of hard to really make a trade when things are moving really fast. So you like to enter these trades when the market's kind of calm. So BABA at 71, and let's see. So my full credit here, if I sell one option, one put, one call, the full credit is $175. So for me, that's not enough bang for my buck. For $175, the margin on that is 891. That's pretty good. I like that. I like that margin requirement, that risk reward ratio for this. So I'm going to go ahead and change this here. This is my risk analysis tool, and if I up this to 2, let's go to 5. $875. That's pretty good. That's pretty for this margin requirement. This is a good bang for your buck. But here's the thing. I have a lot of positions right now that are like this. I have a lot of short Vega and high theta. I have plenty of theta, and I'm still not convinced the market is ready to settle down yet. So I don't want to be too. I don't want to have too much exposure to these kinds of trades. So I'll do this for educational purposes, and because I was talking to my buddy about it, and I want to see if this is going to be a good trade, and see if it actually can make money off it. So I'm going to do it, but I'm going to make it kind of smaller than my usual. If I didn't have all the other trades on, I would probably sell, for my portfolio, $100,000 portfolio with 55,000 of BP left, and in a stable market that wasn't going through all this mess, I'd probably do something like this. I'd sell 5 for a nice $875, but in this case, I'm going to reduce my risk just because I already have plenty of positions like this, and that's part of the trading. This strategy is that you have to make your trades based on what the rest of your portfolio looks like. because I have a lot of these trades already. I don't want to pile up on these same kinds of trades, because if the market tanks, volatility spike, and all my positions will be at losers. So let's go with 350 bucks. I'm going to put this order in, $350 premiums worth of premiums for $1,400 in buying power. Pretty good. Another thing here good is the spread, bid ask spread is 2 pennies, 171 to 173. That's good. I like that. The markets are tight. BABA's liquidity is good, and so I won't get bad fills. If this is a wide range, you might want to stay away from trading those kind of stocks. Like CMG, if I showed you CMG right now, Chipotle, there's huge spreads here, and you can get filled at wide discrepancies, and it's kind of, it can hurt you right off the bat. So in this case, BABA's good. I'm going to go with the, obviously you want to, the more you sell, the better, right? Because you're going to get more premium. So I want to go with 173 and see if I get filled there. And if I didn't get filled right away, that means I might have to wait a little bit. So let's see. Let's see, 173. Let's give it a 30 seconds. Let's give it 30 seconds to see if I get filled. Maybe I can talk about... Okay, I'm going to talk about earnings, and let's see if this gets filled. So BABA here has earnings on 128. Okay, that's 2 weeks from now. So in 2 weeks from now, BABA's going to have earnings, and you never should hold, well, a short strangle is a viable strategy through earnings, but you have to reevaluate the trade on the day of earnings, because it could have moved by then. So here's the thing about the time prior to earnings. From between now and BABA's earnings in 2 weeks, the premiums will probably stay pretty high, because volatility tends to stay very steady or go up prior to earnings. So I won't expect too much, I shouldn't expect too much volatility decrease in this position between now and earnings. But I do expect theta decay. So theta will work in my favor. And if the markets do settle a little bit, if the market does settle, if this volatility kinds of, see, look at the volatility now, it's kind of dropped, right? This morning it was up here, and this is the VIX futures. Volatility kind of dropped and settled now. If volatility can stay, I would say, if it doesn't go any higher than here and stay, and even goes a little bit lower, these for sure will profit as well over the next 2 weeks. I guarantee it. So as long as BABA doesn't move very big and volatility drops a little bit in the markets, and things are a little more calm, plus my theta decay, this will be a profitable trade. I expect this to be, you know, I expect this to make a couple $100. Well, since let's see, maybe $100 by the time BABA is near earnings. All right, I didn't get filled, so I'm going to see. I was at 173, now it's at 171. Yeah, whatever. I'll just chase it a little bit. Ah, they're making me chase it. 171. Come on, 171. Give me 171. Okay, fine, 170. I'll go 170. Filled. All right, so I'm in. 170 BABA. 170. So I have the 60 put and the 82.5 call. I took in $342 of premiums with 36 days left, with earnings on the 28th. So what I'll do is on the 28th, I'm going to hold this until the 28th, unless the market crashes or something, and then, you know, all bets are off at that point. But if the market stays settled, I'm going to hold this. If everything stays normal, I will hold this till the 28th. I'll look at the position at that moment and reevaluate. If there's a profit on that day, I'll probably close it and decide whether I'm going to trade the earnings or I'll just close it. But I probably won't hold it through earnings because that's going to be too risky. So I'll probably reevaluate and close it on the day of earnings, and I expect a profit by then if things are normal in the markets. So let's see how it works out, and we'll check this trade out probably maybe every few days and do a quick recap if it shows something interesting that changes